Over $1.5 trillion in commercial real estate loans will come due between now and the end of 2026. Most were issued when interest rates were near zero, valuations were at record highs, and refinancing was routine. Today, those same buildings are worth less, the tenants are fewer, and the cost of money has more than doubled. That combination, shrinking income and rising debt service, is the fault line running beneath the U.S. economy. Commercial real estate has always been a credit-driven asset class. It's not simply about bricks, glass, and rent. It's about how those cash flows are leveraged to support debt. In normal cycles, higher rents or growing occupancy offset higher rates. But this cycle is different. Post-pandemic behavior, rewired demand, and higher interest costs arrived before valuations had time to adjust. The result is a system quietly trapped between old assumptions and new realities. At first glance, the damage looks localized. Empty offices, quiet downtowns, for lease signs where there used to be lines for coffee. But underneath, balance sheets are shifting. Regional banks, pension funds, insurance companies, and private credit vehicles all depend on property loans that assumed perpetual stability. When even a small share of those loans fail to roll over, the shock transmits far beyond real estate. By mid-2024, national office vacancy rates hovered around 19%, the highest in half a century. In key metros, San Francisco, Washington, D.C., Houston, the rate exceeded 30%. Landlords initially bridged the gap with incentives and optimism, free rent, remodel allowances, short leases. Those tactics bought time but didn't repair the fundamentals. Rental income fell while maintenance and debt costs rose. A building financed at a 3% coupon now faces 7% renewal rates. Every percentage point means millions more in annual interest expense. Even prime assets struggle under that math. In commercial property, refinancing is survival. Loans usually last 5 to 7 years, and few owners ever pay principal outright. They simply roll debt forward. The 2016-2019 vintages are now maturing. As each loan hits renewal, lenders re-underwrite based on current valuations, which are down 20 to 40% in most markets. A property once appraised at $500 million may now support only $300 million in debt. Unless the owner injects new equity, default becomes the rational choice. A visible example surfaced in Los Angeles during 2025. A 30-story office tower carrying a $250 million mortgage sought refinancing. Occupancy had slipped from 94% to barely 50%. New appraisals valued it near $160 million. The bank offered a $130 million refinance. Rather than raise capital to fill the gap, the borrower surrendered the keys. To the public, it looked like one vacant building. To the lender, it was an unplanned ownership transfer and an immediate write-down. Hundreds of similar stories are forming quietly across the country. This matters because commercial loans are not held in isolation. They're packaged into commercial mortgage-backed securities, CMBS, and sold to investors seeking stable income. Those securities sit inside pension funds, insurance portfolios, and money market vehicles. When the underlying borrowers default, coupon payments to investors falter, forcing markdowns. Losses that start with one downtown tower can ripple through retirement accounts, insurer reserves, and bank capital ratios. Small and mid-sized banks are especially vulnerable. They originate roughly 70% of all commercial property loans in the United States. Many operate within narrow geographic footprints. If one local market deteriorates, their collateral base deteriorates with it. Unlike the large money center banks stress-tested after 2008, regionals lack diversified income streams. For them, a few non-performing loans can erode capital fast. That's why analysts now track the health of these lenders as a proxy for systemic risk. Meanwhile, risk migration has created a second front. As traditional banks tightened standards, private credit funds stepped in. By 2025, these shadow lenders controlled roughly $700 billion in commercial property exposure, often financed with investor money seeking yield. Many loans carry floating rates. When the Federal Reserve raised policy rates from 0.25 to 5%, borrowing costs for those funds surged, compressing margins or turning them negative. Several managers have since gated redemptions, the first liquidity freeze since the global financial crisis era. Despite these stresses, markets appear calm. Equity indices remain near highs, employment data looks solid, and consumer confidence has not collapsed. But that stability is optical. Financial history shows that property downturns move slower than equity corrections. They accumulate unrecognized losses until accounting rules or funding pressure forces disclosure. That's the stage we're in now. Losses without recognition. Potential catalysts are visible. A regional bank could unload a portfolio of delinquent loans, setting new low-price benchmarks. Rating agencies could downgrade CMBS tranches, triggering forced sales by institutional holders. An insurer might admit mark-to-market losses on office exposure. Any of these would break the facade of stability and reprice risk across the system. The timeline aligns almost perfectly with historical lag patterns. After the 2001 recession, office vacancies peaked in 2003. After 2008, they peaked in 2010. Commercial property cycles trail broader economic shifts by roughly 2 to 3 years. Given that the pandemic shock hit in 2020, the maturity of loans and the peak of stress fall naturally around 2026. That's why many analysts refer to this as the delayed echo of COVID. Remote work isn't the sole cause, but it cemented a structural decline in office demand. Even firms mandating office returns average occupancy near 60% of 2019 levels. That structural underutilization means millions of square feet now produce partial revenue while carrying full debt loads. Add rising insurance premiums, higher operating costs, and refinancing risk, and the economics collapse quickly. Municipal finances will feel a secondary shock. City budgets rely heavily on property tax assessments that trail market values by about 2 years. When commercial appraisals fall 30%, the tax base follows. Revenue shortfalls force budget cuts or higher taxes, either of which makes downtowns less attractive. The feedback loop is brutal. Vacancy. Lower valuation, weaker tax base, degraded services, more vacancy. This erosion doesn't make headlines like a stock crash. It appears slowly. Dark windows, shorter lunch lines, quieter streets. Yet each empty office represents a contracted service, a dismissed worker, a lost municipal dollar. The cumulative effect is urban deflation, the steady withdrawal of economic energy from city centers. Investors once called real estate a slow asset. That phrase implied safety. Values changed gradually, allowing lenders time to adjust. But leverage compresses time. When loans mature faster than market recovery, slow turns sudden. That's the essence of the 2026 risk. Debt clocks running faster than demand clocks. At the analytical level, everything circles back to one question. Who absorbs the losses? If owners default, banks and bondholders take the hit. If regulators intervene, taxpayers share it. If neither acts, the drag persists through reduced credit creation. Each option carries economic consequences, lower lending, slower growth, and potential political backlash. So far, denial still dominates. Accounting conventions allow lenders to categorize problem loans as special mention rather than non-performing, postponing recognition. Investors accept opaque valuations in private credit funds because redemption gates hide true pricing. But arithmetic is patient. It waits for maturity dates, and by late 2026, maturities will force disclosure. The outcome may not look like 2008's cascade of panic. It will be quieter. Buildings changing ownership. Balance sheets shrinking. New capital stepping in at lower prices. Value will not vanish. It will transfer. From leveraged owners to cash buyers. From optimistic developers to distressed debt specialists. From regional banks to private equity funds. That transfer defines every real estate reset in history. When it begins, the skyline won't change overnight. But accountants, auditors, and city treasurers will notice first. And as they adjust their numbers, the headlines will follow. That's how slow crises end. Suddenly, and with the realization that the numbers were warning us all along. The deeper risk of the commercial real estate downturn isn't only in the loans that default, it's in the ones that don't. Thousands of properties are still current on paper, paying interest each month, but only because lenders quietly adjusted terms, extended maturities, or capitalized unpaid interest. This practice, known in the industry as extend and pretend, postpones recognition of losses, but doesn't eliminate them. It is the same logic that preceded Japan's lost decade in the 1990s, a decade defined by banks unwilling to admit what their assets were truly worth. At first, extending loans seems harmless. It avoids fire sales, stabilizes markets, and buys time for recovery. But over time, it freezes capital inside underperforming assets. Banks that could be lending to new businesses remain tied up in old ones. Developers who might redeploy capital into growth projects are stuck maintaining empty buildings. And investors, misled by balance sheets that still list properties at outdated values, miss price risk across the economy. Regulators face a dilemma. Forcing banks to mark down assets could trigger a credit contraction. Allowing them to ignore losses risks a prolonged stagnation. The Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency all understand this balance. Behind closed doors, supervisors have begun quietly surveying regional banks about their commercial exposure. In private briefings, some institutions report that a full revaluation of office portfolios could wipe out as much as 30% of tangible equity. Those numbers never reach public filings, but they guide regulatory tone. Large institutions are better prepared. They have diversified income from consumer lending, credit cards, and trading. Regional lenders, however, often have half their loan books tied to property. The most vulnerable are those with less than $250 billion in assets. Too small to diversify globally, too large to escape regulatory attention. These are the same lenders that finance small businesses, local developers, and community infrastructure. When their balance sheets tighten, Credit in the broader economy tightens with them. The Federal Reserve is aware of the feedback loop. Its own financial stability reports note that a significant share of commercial mortgage debt is held by institutions with concentrated geographic exposure. Translated, that means a handful of city-based banks carry most of the risk for their regions. If even one fails, the psychological contagion can spread faster than the financial. Depositors move funds, counterparties pull lines, liquidity disappears. Early version of this dynamic in 2023 with several mid-sized bank failures that began as localized issues but quickly escalated through social media and deposit flight. Commercial property stress could trigger a similar pattern, albeit more slowly and with less public panic. Investors are beginning to price the risk, though not fully. Equity markets remain optimistic, but bond spreads for regional bank debt have widened. Credit default swap pricing, a market-based insurance on default risk, has quietly risen for financial issuers with heavy real estate exposure. Meanwhile, hedge funds are shorting CMBS tranches tied to downtown office portfolios, a strategy reminiscent of the early subprime trades before 2008. This isn't a sign of imminent collapse. It's a reflection of growing uncertainty about who ultimately holds the exposure. Internationally, foreign investors are pulling back. Before the pandemic, global capital flowed freely into U.S. office towers. Canadian pension plans, Middle Eastern sovereign funds, and Asian insurers viewed American commercial property as a stable yield play. Now, many are exiting or demanding higher returns to compensate for risk. Capital inflows to U.S. real estate fell more than 50% between 2019 and 2024. That shift adds another layer of pressure. Fewer buyers mean lower prices and reduced liquidity. The macroeconomic context compounds the problem. Inflation, though moderating, keeps interest rates elevated. Even if the Federal Reserve begins cutting in 2025, rates are unlikely to return to pre-2020 levels. That means refinancing costs remain structurally higher for years. And because commercial real estate relies on long-duration assets financed with short-term debt, the mismatch persists. Higher for longer interest rates transform every refinancing into a stress test. Some policymakers hope time will solve the problem. If the economy avoids recession, if job growth holds, and if hybrid work stabilizes at higher office utilization, then cash flows could gradually recover. But each of those ifs rests on optimistic assumptions. The more realistic scenario is a slow, uneven adjustment. New uses will emerge for obsolete space, residential conversions, medical offices, flexible work hubs, but those transitions take years and cost billions. Until then, the loans remain on bank books, depreciating quietly. This slow-motion correction carries political implications. Property tax shortfalls strain city budgets, forcing debates over service cuts, borrowing, or state bailouts. In 2025, several major cities already announced budget gaps tied to falling assessments. San Francisco projected a $780 million shortfall over 5 years. Chicago warned of similar declines. If those gaps widen, municipal bond markets could start demanding higher yields, increasing borrowing costs for local governments nationwide. It's a chain reaction that starts with empty floors and ends with higher taxes for residents. The federal government may eventually intervene, though not in the same way it did in 2008. Back then, the crisis was systemic and immediate. This one is granular and drawn out. Instead of a sweeping bailout, expect targeted liquidity programs, lending facilities for small banks, credit guarantees for CMBS, or incentives for property conversion. Such tools would buy time, but not reverse the underlying trend. Real estate valuations adjust through price, not policy. Meanwhile, the private market is preparing for the next phase, distressed opportunity. Special situations funds, hedge funds, and private equity firms are already raising capital to buy discounted loans and foreclosed assets. They view the coming years as a generational buying window. In previous cycles, these investors stepped in around the midpoint of correction, when fear is high but liquidity still exists. By 2026, many expect a flood of assets hitting the market at 50 to 60 cents on the dollar. History suggests that's when the transfer of ownership accelerates. For long-term investors, the distinction between collapse and correction is perspective. From a lender's view, defaults mean losses. From a buyer's view, they mean opportunity. Real estate rarely disappears. It changes hands at new prices. The danger lies not in the buildings themselves, but in the balance sheets built around them. Understanding that distinction helps clarify the broader narrative. The commercial property downturn is not the next housing crisis. It's a credit repricing event. It won't topple the financial system, but it will reshape who controls its assets. Banks and leveraged owners will shrink, cash-rich investors will expand, municipalities will adapt or decline depending on how fast they repurpose their cores. The adjustment will be slow, uneven, and deeply geographic. In the financial markets, patience becomes strategy. Those expecting a quick rebound in office valuations will likely be disappointed. Capital will shift toward logistics, data centers, industrial parks, and multifamily conversions, sectors aligned with new demand patterns. That's the rotation phase, where capital abandons old winners for new ones. It is the same structural evolution seen after every economic shock, from railroads to tech to housing. By the end of 2026, the refinancing wave will have largely passed. Some owners will have survived through equity infusions or creative financing. Others will have walked away. Balance sheets across the financial sector will look smaller but cleaner. Losses will be booked, capital reallocated, and a new cycle will begin. The system will reset, as it always does, not through collapse, but through transfer. What remains uncertain is the pace. The longer institutions delay recognition, the longer growth remains subdued. History's lesson is clear. Economies recover faster when they confront reality sooner. Japan's experience in the 1990s, Europe's after 2011, even the US in the early 1980s, each demonstrated that delay turns correction into stagnation. America now faces that choice in miniature through its commercial real estate market. Admit the losses and move forward, or conceal them and endure a slow bleed. For now, the signs are visible only to those who look closely. Valuation write-downs, rising delinquency rates, and shrinking bank loan growth. They don't yet make the nightly news, but they are the early chapters of an inevitable adjustment. When the reckoning arrives, it will seem sudden. But those watching the numbers will know it was building all along, one maturity date at a time. By late 2026, the scale of the commercial real estate correction will finally be measurable. What began as isolated loan extensions will have evolved into a nationwide repricing of risk. Vacancy charts will flatten, not because occupancy recovered, but because lenders and owners accepted new baselines. The market will have recalibrated around a smaller, leaner definition of normal. The immediate consequence will be tighter credit. Banks emerging from loss recognition will preserve capital by lending less. Developers dependent on easy refinancing will disappear. The flow of new projects, office towers, hotels, shopping centers, will slow to a fraction of pre-2020 levels. That reduction in construction will act as both a drag and a stabilizer. It suppresses short-term growth but prevents oversupply from worsening. The Federal Reserve will face its own dilemma. Lower demand from the property sector exerts downward pressure on inflation, yet tighter credit restrains growth. Policymakers must balance two competing forces, maintain stability or stimulate activity. If they cut rates too quickly, they risk reigniting speculation. If they hold too high for too long, they deepen the slowdown. The likely outcome is a measured easing cycle, gradual cuts paired with liquidity programs targeted at regional banks. Unlike 2008, the Fed will not rescue property prices. It will protect funding markets, ensuring that solvent institutions can meet obligations, but it will allow valuations to adjust. From price preservation to process preservation, regulators now view downturns as necessary recalibrations rather than anomalies to be avoided. For investors, the adjustment will redefine what safe yield means. Commercial mortgages, once considered nearly risk-free, will carry permanent risk premiums. The spread between government bonds and CMBS will stay wider for years, reflecting scarred confidence. Institutional portfolios will rotate toward assets with clearer demand visibility, logistics facilities, data centers, and multifamily housing. Those sectors benefit from structural tailwinds: e-commerce, cloud infrastructure, and chronic housing shortages. In effect, the capital that once financed cubicles will finance servers and apartments. This rotation mirrors broader economic transformation. Just as the manufacturing decline of the 1970s gave rise to suburban growth, the post-office era will reshape urban cores. Developers will convert outdated towers into mixed-use projects, residential floors above, retail and co-working below. But conversions are expensive. Plumbing, light access, and code compliance make adaptations slow and selective. Analysts estimate that at most 15% of obsolete office stock can viably convert to housing. That means many towers will remain stranded assets for a decade or more. Municipal planning will become an economic frontier. Cities that manage to repurpose quickly will attract residents and investment. Those that don't will endure population outflows and fiscal strain. Examples are already visible. Miami and Austin diversified early, promoting technology and mixed-use zoning. Downtown recoveries there outpaced national averages. San Francisco and Chicago, burdened by legacy zoning and high costs, lag behind. Urban success in the 2030s will depend less on skyscraper counts and more on flexibility. The labor market will reflect the shift. Commercial real estate services, from leasing agents to janitorial contractors, employ millions. As buildings consolidate, those jobs will contract. Yet demand will rise in sectors like construction retrofitting, logistics management, and residential development. Employment will not vanish, it will migrate. For policymakers, retraining programs will be key to absorbing displaced workers. Pension funds and insurance companies, heavy holders of property debt, will navigate a multi-year adjustment as well. Mark-to-market losses reduce reported funding ratios, compelling higher contributions from employers and governments. That fiscal burden will surface gradually in local budgets. It won't provoke crisis headlines, but it will influence spending priorities. Less capital for infrastructure, more for pension stabilization. The effects ripple quietly through public finance, reinforcing the theme of this entire cycle: slow motion contagion. On Wall Street, the narrative will eventually shift from collapse to reset. By 2027, opportunistic investors will dominate headlines: funds buying distressed loans, developers purchasing half-finished projects, new lenders offering capital at higher spreads. These stories will signal the trough. Every real estate downturn ends when pessimism becomes an investment thesis. At that stage, prices stop falling because buyers stop waiting. For households, the impact will be indirect but real. Credit contraction limits small business borrowing. Reduced municipal revenue trims local services. Office closures influence retail corridors and transit systems, altering daily life. In aggregate, the result is a subtler form of recession, less visible in GDP, but felt in slower wage growth and shrinking city vibrancy. Economists may call it urban deflation, a long period of adjustment in which cities shed excess capacity. International markets will observe closely. The U.S. property system underpins trillions in global collateral. A controlled adjustment reinforces confidence in American credit discipline. An uncontrolled one erodes it. For now, foreign observers note that transparency and legal frameworks still make U.S. assets safer than alternatives. That reputation ensures continued capital inflows once prices stabilize, cementing America's role as the world's largest distressed asset marketplace. Long-term, the commercial real estate correction will accelerate an existing trend: the financialization of everything. As traditional lenders retreat, specialized investment vehicles will dominate property finance, private equity funds, sovereign wealth partnerships, and institutional investors using structured products. The market will become more concentrated, more professional, and less local. That shift brings efficiency, but also fragility. Fewer players. Controlling larger pools of assets means less diversity in decision-making. Technological transformation will run parallel. AI-driven valuation models, blockchain-based title systems, and digital leasing platforms will emerge as responses to opacity revealed by the downturn. These tools aim to shorten the lag between reality and recognition, the very lag that allowed this crisis to form. If adopted widely, they could make future corrections faster and less painful, though never preventable. The psychological arc of every financial cycle follows the same pattern: denial, acceptance, opportunity. Right now, the commercial property sector sits between the first two. Denial manifests in optimistic press releases and temporary vacancy signage. Acceptance will come through financial statements and quarterly losses. Opportunity follows when capital, unburdened by illusion, re-enters at rational prices. The transition between stages defines how painful or productive the outcome becomes. From a macro perspective, the 2026 collapse will not trigger systemic panic. It will mark the end of an era. The age of cheap debt and infinite office demand is over. The U.S. economy will adapt, as it always has, by reallocating resources to where returns justify risk. That process is disruptive but healthy. It prunes inefficiency and reprices complacency. And in its wake, a leaner, more transparent financial architecture emerges. For investors seeking guidance, three principles stand out. First, liquidity is defense. Those who avoided excessive leverage will navigate volatility and exploit discounts. Second, location still matters, but function matters more. Buildings adaptable to new uses will preserve value. Single-purpose assets will not. Third, time is capital. In slow cycles, patience compounds more reliably than speculation. Owning cash can be an advantage, not a burden. By 2028, analysts will look back and label this episode with a convenient headline: the office crash, the work-from-home reckoning, perhaps the refinancing wall. But beneath the label, the meaning will remain the same, a reminder that credit cycles never disappear, they only evolve. Each generation discovers this through a different asset class. In the 1980s, it was savings and loans. In the 2000s, it was housing. In the 2020s, it is the office tower. The skyline will endure. Buildings will change owners, tenants will return in new forms, and cities will adapt to their economic base. But the illusion that real estate is immune to disruption will fade. Financial systems built on optimism eventually meet arithmetic. Arithmetic always wins. As 2026 turns to 2027, that lesson will be clear to every banker, developer, and policymaker reading their balance sheets. The losses will have been recognized, the ownership transferred, and the system reset. What remains is the realization that the crisis wasn't sudden at all. It was visible in every empty window, every refinancing delay, every quietly extended loan. And as analysts tally the final numbers, they'll reach a single conclusion. The commercial real estate collapse of 2026 didn't destroy American finance. It reminded it how gravity works.